I don't know if this is my most important video, but it is one of my most important videos to be sure. Today, as I record this, it's Friday the 13th. Hope this is a lucky, not unlucky day for you. And I approach this the same way I would if I were going to do what the topic of this is, which is 3 ways to sell seller finance. So I actually wrote down what I wanted to talk about. One of the things that a lot of people don't do is when they talk to a seller, they don't have an exact desired outcome. They haven't thought through what is it that I want to say and have happen in this interaction. So, hence the reason I did this. Okay. So, what is seller finance? That sounds pretty simple, but a lot of people have said they don't understand it. So I just want to make that as simple as possible. Seller finance is a transaction in which the seller acts as the bank, takes the loan, typically gets the interest, and there may not even be the need to include a bank. Okay? So first we understand what it is, certainly. One of the things that's most important here is to make sure you have sold yourself first. It's my number one rule of selling. Unless you believe that this is advantageous to the buyer, then it doesn't work. And conversely, if you don't make this something that the seller wants to do and sees the benefits of it, then that doesn't work as well. So let's talk about how you would do those things. So each seller has unique needs. Your job is to figure out what those needs are, and those could be several things, but you want usually to have very clearly in your mind what your criteria is. A highly motivated seller, usually an older person looking to transition into retirement, and somebody that doesn't have a whole lot of debt on the business, because normally you've got to clear the debt if you want to use seller finance. Okay? So the question is, can you satisfy those needs, and are those needs in the potential seller that you're talking to? And a simple example of that is if you're 25 years old and you want to buy your first car, you probably aren't going to look for a minivan. So why would I try to sell you a minivan? I wouldn't. I'd try to figure out what it is you want and then meet those needs. Okay? So let's prepare for that first meeting. And what I said here was, have in your toolbox the benefits of seller finance, both to you and to the seller. So know what it is that this type of financing has to offer. And again, first you have to convince yourself. If you're confident that this can work and work for the seller and is oftentimes the best choice for the seller, this becomes a whole lot easier, okay? So for the buyer, lower capital requirements. That's part of it's obvious. You may not even need a down payment with that, certainly. Improve financial terms. The seller can often get more flexible terms compared to traditional lenders. So not only does that impact the buyer, but it also impacts the seller. And typically, in that case, you're going to find that you will be in a position where almost, not entirely, but almost, you name the price and I'll name the terms to that seller. Easier access to deals, that often mitigates sellers' concerns that if they find that they can offset an awful lot of the things that traditionally would be a problem. Maybe they're concerned about your credit. Now, they're still going to be concerned about your credit, but are you going to be able to qualify for a bank? In this case, they're the bank, so they don't have that concern. Alignment of interests with seller finance, you can put yourself, and we'll talk more about this, on the same page as the seller so that they're more comfortable with the transition and the transition to you of their business. And negotiation leverage. Buyers might be able to negotiate more favorable terms. Again, you name the price, I'll name the terms. Okay, so that's you. And think about those things and write those things down and get comfortable with those things. For the seller, okay, obviously a faster sale process. You don't have to go through the entire process with a bank and the credit committees and those whole things. Fastest I ever had someone do a seller finance deal from introduction to closing I know this is going to be hard to believe, but 9 days. 9 days. Higher sale price. Oftentimes, these businesses are run like mom and pop businesses, and they have expenses. And I'm not talking about those that are crooks, legitimate. They may pay their husband and wife $200,000 a year to do the books. That's not going to be your expense when you run the business. So you might say, okay, you're paying $200,000, and we're not going to need $200,000 to get a bookkeeper. We're going to only need $50,000 or $80,000. So in that case, we could add back $120,000 or $150,000 back to the EBITDA number. Banks probably wouldn't be as inclined to look at those add backs. When you're looking at add backs, though, a seller typically is going to throw all kinds of things in there, and that's a negotiation. Okay? The tax advantages, you can't advise them on their tax situation. I guess you can, but you shouldn't. Say to them that you're going to get payments over time, so there may be a tax advantage to you. That's something that you need to talk to your seller about. Income stream, they're going to get a stream of income over time, which might help them in retirement. And although this is a double-edged sword, it increases their pool of buyers. But that said, it allows for a transaction with someone who doesn't have all the capital that they would need traditionally in a bank, which oftentimes is you. Okay? Okay. So oftentimes seller finance can be a win-win. Again, you're going to look at the items, you're going to find which fit the seller. So let's talk about that. So as the title of this video said, 3 ways to sell seller finance. So let's talk about those. And you want to first identify what the needs are of that potential seller. And these are probably the top 3. There are other reasons that a seller would want to sell to you. Okay? So first, commitment to preserving the legacy and employees. This is something that oftentimes is said, but not always is true, is that the seller may have been in business for 40 years, may have had long-time employees, and may care about those employees. However, they may care more about the money. So in that case, obviously, the price is important, as it always is. But how real is that need for them? The legacy, et cetera, et cetera. And what you're going to find is that if you can, and you can't initially do this, but if you can make the commitment that this thing is not broken, your business is not broken. We want to continue the legacy. We want to take advantages of the reputation you've built, the employees you've put in place, and assuming that those employees do what they're supposed to do and are the right employees, we see no reason to change that. You cannot make that commitment before you know who the employees are, what they've done, are they the right people, et cetera, et cetera. And I would be honest about that. Tell them, we'll need to assess that you've made the right choices, but given your success, we think that'll probably work out. Okay. The confidence that those employees will be treated well and will be a concern, and certainly a situation where those employees in this business and the reputation will be conducted the same way it was, or at least to the best of your ability. PE oftentimes will rebrand and will not be able to do that. We're going to change the name, we're going to change the way you do business. If you've done, for instance, some pro bono work, nope, those days are over. We don't care about helping the community, et cetera, et cetera. We care about making money, which we care about making money too, but you can do both things. And again, sometimes it's true, sometimes it's not true, but I have a mentee who one of his deals was in a healthcare sector. The seller was absolutely committed to the employees and said there's $700,000 in the bank. You can have that bank to make sure that you don't have any capital issues. I'm really healed financially very well, so just go ahead and pay me $110,000 over 7 years. That's seller finance. And really, with the current inflation and interest rates, if they're negotiated well, And this was no interest rate, just 110 over 7 years. He basically, the mentee was paid to take that business. Will you run into that every day? No, you will not. Will you run into that if you do enough deals? Yes, you will. Okay? So, smooth transition and seller involvement. One of the things that oftentimes sellers do not recognize is that they don't have to sell the whole business. And in our model, 60-40, 51-49, as long as you have majority, those things certainly work. And they keep the seller invested in the business. That gives some comfort to them that it's going to be run as it was previously. And they may not be ready to walk away. They may not be ready to stop working immediately. So you want a transition period. You want them potentially not only to have seller financing, but seller equity in that deal as well. So, key points I listed on that. It reduces the anxiety around handing over control. It may. Ensures business continuity with minimal disruption. Potentially true. Offers the seller an opportunity to help maintain customer and employee relations during the transition. That's super important. These businesses may have referral sources and long-term customers that once the seller steps away, they say, well, we'll look at where else we can do business. And with this technique and keeping the seller in the deal, you're going to mitigate that, certainly. They allows the seller to keep working. And then with respect to seller finance and the benefits to them, if you went to a bank, the seller would be in a second position. If something went wrong with the financing, the bank would step in and secure their interest first, leaving whatever is left for the potential previous owner, or maybe current owner if it's an equity deal as well. So you put the seller in the first position, and you also are in a position where they get the loan interest as well, certainly. Okay, so financial security, we've talked about that. Seller financing, we've obviously talked about that. But last but not least, and usually very important to the seller, is the price. Is it, again, we've talked about add backs, which increases the EBITDA, which will increase the purchase price. There can be the interest that they get as a seller as opposed to the bank, certainly as well. So and it's also going to provide a steady income of revenue at the point that they walk away or even during the point that they're working. So you structure that such that you've looked at what they need, you've looked at how what they need can be tied into running the business. You can give them bonuses for performance. I would not do an earnout. A lot of people talk about earnouts, future profitability. And that can have a lot of problems and often end up in litigation because you might do some things, maybe you raise prices and you drive away some business as a result. If I'm on the other side, I would say, that shouldn't penalize me. You didn't have to raise prices, you did, it affected the business. So I think it's unfair that you reduce the profitability through that process. Maybe it works the other way as well, which won't be a concern. But bonuses based on performance, much better way to go, in my opinion. Okay? And then for the seller, essentially, this, as I mentioned, this can be a faster process, certainly. It can give them, just recapping here, income stream, still control, their employees treated better, et cetera, et cetera, et cetera. So go back through this video, think about your prospects, think about what they want, not what you want, what they want. Be sure you focus on their needs, match this approach, seller finance, with what they want, and you will pretty successfully, oftentimes, separate yourself from the bots, separate yourself from private equity, and come across as someone who is interested in their business, the legacy of their business, and what's important to them. Oftentimes, you'll hear something like, well, what are you going to do for me that I can't do for myself? And the natural tendency, without knowing their needs, for bots is to say, well, we're going to take over administration, we're going to take over marketing, we're going to take over insurance, whatever it is. Those may all be fine. We don't know that. So a better answer is, I don't know what we're going to do for you. I don't know if we can do anything for you. And why? Because I don't know what your goals are. I don't know what you struggle with. And they may say, well, our marketing, we struggle a lot with that. In today's market, we struggle with labor, how to get labor. We're really short-staffed. And then you can address those needs and what you can do as basically a partner with them in this majority interest of running the business with them and taking over perhaps acquisition of labor, et cetera, et cetera. So think about seller finance. Convince yourself that it is a viable means to buy the business and that it will benefit the seller. Obviously, you've thought about why it will benefit you as well. But it's oftentimes overlooked. And one of the things that I've heard over and over again is, I really didn't understand it, and I really didn't feel that there was a benefit to the seller. Well, there is. Think about it. As I did here, write down what you want to talk about. Write down what your exact desired outcome is from those meetings with the seller, and you will be in a much better position to have a successful outcome from the seller. So I hope that helps. We're in the process of adding some people to the VIP Mastermind where we do tons of role plays, things like seller financing role plays. That next one, as I record this, is September 19th and 20th. You could still have an opportunity to potentially, depending upon how many people are added, add to that 19th and 20th 2-day virtual training with my marketing director and me. But go over to brucewhipple.com, look at the coaching section, look at the VIP, and that'll give you a good feel. But seller finance, quickest way to the goal line if you can make it work. Do your due diligence, but oftentimes, even if you run into some problems running the business, you can go back to the seller and get some consideration to have maybe take time off in the payments, etc., which the banks are typically not going to be as helpful in working through that with you. So, viable way to finance a business, oftentimes the best and quickest way for you.